Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Fidelity Canada recently launched a new investment opportunity for accredited investors, Fidelity Alternative Real Estate Trust. It's co-managed by Brookfield Asset Management. This Fidelity Fund holds a mix of public and private real estate investments, combining the best of both worlds in one core portfolio. So why should investors take a look at this and have it on their radar? And what sets this fund apart from others that are on the market? Joining us here today to introduce the fund is Portfolio Manager Don Newman and Director of Alternatives, Rory Poole. So warm welcome to Don and Rory. Great to see you both.
Thanks, Pamela.
And congrats on this new fund, which has launched recently, as we just said. Don, let's begin with you. You're the Portfolio Manager of this fund. REITs and the whole real estate dynamic are nothing new to you. You've been, actually, were you an analyst?
Yeah, I've spent a portion of my career being the Fidelity real estate analyst here in Canada. And for the last 15 years or so, I've been running a sort of a decent part of some of my funds, specifically looking at the real estate sector. So this is nothing new to me, and I'm really excited to get this fund up and going.
Okay, well, let's hear more about it over the next little while. Tell us about this fund, Rory. This is something that did not happen yesterday. I mean, you've been working at this for some time. Give us a little bit of background, how this fund came to be.
Sure, Pamela. And yeah, much to my chagrin, this isn't the type of product that's just built or sprung up overnight. No. Don's been a part of that process the whole way along. But if I'm to give you a little bit of the genesis to kind of get you to what we're here to talk about today, which is the new Fidelity Alternative Real Estate Trust. Back probably 3 to 4 years ago, I would say, we kind of started this process with Brookfield.
So where were we 3 to 4 years ago? We're coming out of COVID, basically.
Basically, I'd say a little bit after that. Okay. But we're starting to have some conversations around bringing some new capabilities to our platform for a number of different reasons, which I'll describe in just a moment. But the kind of first step in that process was obviously setting up a portfolio or a limited partnership where Brookfield could start to invest in Canadian private real estate on our behalf. And this was a capability that was specific to the various channels that exist at Fidelity. And so probably a year after that process started, we were able to get to the point where some of our multi-asset class funds or our large balance funds were able to invest in this new capability that we had stood up. And the second part of that whole project was always to create a vehicle that would allow the Canadian Vice Channel or advisors to access that same building block, if you will, of private real estate, but within a portfolio that is a little bit more kind of tailored towards their market, in which they can gain exposure to that piece in a little bit more of a concentrated fashion.
So where is this real estate first? And then we'll get some of the ABCs of it.
Sure. So in terms of within this fund, and it's important to mention that we're talking a little bit about the component that Brookfield's managing on our behalf, but also Don is managing a sleeve of listed real estate investment trusts on the side of that.
So it's 30-70.
Exactly. Yep. So it focuses on the mix that you just mentioned, but in terms of the private component of the portfolio, it is focused on Canadian private real estate. Don can speak to his piece a little bit more, and he's got a little bit more flexibility in that sense.
Yeah, so this is the 30% that you're managing that is public. Tell us a bit about what is the universe of it, first of all.
So this is exciting. So we've got the wonderful, just stepping back a little bit, we've got this put together a fund that I think should have characteristics that investors are really interested in. So we've managed to get Brookfield on the private side. So probably about 70% of the fund, although I have the ability to flex depending on market conditions. But a company that has really deep roots, decades of relationships, and one of the sort of the largest Canadian private investors in real estate, working on the private side. And then on the public side, which is what I'll be working on, it's basically a portfolio of North American real estate investment trust and I've got lots of flexibility on sectors. So we can go anywhere from multifamily, single family, industrial, look at healthcare, seniors housing, data centers, like sort of all the way across the gamut, and we have the ability to invest sort of anywhere, sort of both US and Canada. And I think combining those two portfolios offers sort of a wonderful combination of both income, potential for capital gains over time, and with the private portion of it, you probably get a little bit less. You get probably, as of late, a lot less volatility than the overall market.
Okay, let's hold on that for a second, because the vol story right now is massive.
It's a really wonderful combination for people who are looking to diversify their portfolio outside of the usual 60-40 type portfolio they might be holding now.
Fascinating, fascinating. Some of the sectors that Don just mentioned there, are they mirrored in the private side of things?
Some, I would say. In terms of the private piece, the general focus over time will be investing in a combination of industrial properties, multifamily properties, potential for retail properties, office, which is not in the portfolio right now, and we can talk a little bit about maybe why that's the case. But the intention is to have kind of a diverse portfolio of these privately held assets in Canada within that piece.
And in both cases, there are assets that are within this that you hope will improve and go up in value. Tell us a little bit about how that works. So, Brookfield will be managing these actual physical properties that exist across Canada. What is a little bit of the value case? I'll ask you both this question.
Sure. So to answer your question specifically, like how do these properties potentially grow in terms of value, if you will, over time? I think there's a number of ways that can happen. To mention a few, I think one is kind of leveraging what Don just mentioned in terms of the fact that like Brookfield's operating platform is a huge part of the potential for increased value within that segment of the portfolio.
Yeah,
exactly. Yeah. I mean, think of it. I mean, let's use an industrial building, for example, and say that industrial building has 5 tenants within it, but they have the capability to have 6 tenants within the building. They're relying on their operating network to go out there and, as Don mentioned, lease that additional space, which will create more cash flow for that of the investment, and with the hopes of increasing its value over time. The second has to do with the fact that real estate is something that, at least on a gradual basis over time, it's a physical asset. And so it's correlated with inflation. So as the prices of goods go up, the prices of properties, generally speaking, tends to have a fairly high degree of correlation to that.
It's really interesting. Yeah, the hedge to inflation. I mean, this is a long-term real estate piece of the story, but do you want to just speak to that for investors right now who might be thinking about that?
I think if you look over a long period of time, owning physical assets is a great way to sort of hedge yourself off against inflation in the system. You have most real estate, when you actually enter sort of a contract, and it depends on, some are 10-year leases, some are like industrial, usually 5-year leases. But when you enter that sort of contract, the lessee is usually going in and saying, every year or every 5 years or every 10 years, there's contractual step-ups. So just underneath that, which are in some cases inflation, in some cases they exceed inflation, and depending on sort of where we are in cycles. But those contractual step-ups mean the rent you're getting every few years actually sort of will be increasing and can offset inflation over time. And then if you add in sort of increases in demand, additional properties, acquired sort of efficiencies you may get through economies of scale. There's a lot of things that can be sort of put in to a real estate portfolio that is a really wonderful thing for people over time, that offsets that inflation and generates an increasing cash flow to the investor.
And let's sort of come back to the appreciation over time and the investor that this is perfect for. It's not going to be short-term. Obviously, real estate by nature isn't. But do you want to just speak to sort of who this is for? For
sure. You mentioned an important point at the beginning. This is for accredited investors. Okay. And I won't go through the full list of what defines an accredited investor today, but generally speaking, it has to do with one's either income or the assets that they potentially possess. But I think that the type of investor to describe some kind of characteristics, you mentioned it first, is the fact that like this is meant for longer term investors. We've been talking about the fact that a big piece of this portfolio is invested in illiquid assets. There's a lot of pros that come along with that, but the key is that they are illiquid. And so the vehicle that an investor or advisor would purchase in the Fidelity Alternative Real Estate Trust, well, we do provide some liquidity on that. It's not the same as a traditional mutual fund or a daily traded ETF. And so someone, I think, has to have, call it a minimum of like a 3 to 5 year time horizon as to which they want to potentially see the fruits of the labor from this portfolio.
Okay. Anything to add to that, Don? The sort of compounding nature, but longer term.
Yeah, I mean, I think, as we say, this isn't a trading vehicle. This is something like Brookfield's going and buying these assets for, hopefully generations. And they're all, what's really great about this portfolio is, frankly, it's new. Like, we're just starting this portfolio. We're buying the assets. We're going to continue to start buying the assets, and any sort of market opportunities that are available, Brookfield can go and put the sort of the new money to work that's coming into the fund into these assets. But for people that are sort of looking at something that diversifies their portfolio, has good income, capital appreciation over time, but they can just sort of put it aside and say, hey, listen, I'm looking at a 5 and 10 year outlook, and to generate income, to hopefully to have an increased value over a period of time, and to diversify my portfolio. It's an absolute great asset for someone who needs the liquidity in 6 months, a year. This is probably not the product for you, but for someone that's looking for diversity and, as I say, sort of that income and capital growth over time, this should be a wonderful product.
Really interesting. Can I ask you about office now? Let's just dig in, because it's one of the stories from the pandemic. We've changed our ways. Where does it sit at this point? Why would it be interesting later?
I mean, yeah, I'll first start by saying, which I alluded to, is that it's not currently in the Brookfield part of the portfolio. And I think a lot of that has to just do with the fact that when pockets of the real estate market go through a very difficult period, as office has over the course of the past couple of years, like, it takes a little bit of time to course correct. Right. So that doesn't mean that there won't be potential opportunities within office on a go-forward basis. It just means that for the time being, whether it is relatively wide bid-ask spreads that exist within the space, whether there's still some uncertainty around this bifurcation that we've seen, where some folks believe that there's parts of the office market that are super high quality and that are not necessarily going to become obsolete, but that there's other parts of the market where it's the complete opposite.
Totally.
I think that if you're to kind of summarize the fundamental outlook, if you will, across sectors, office is just not at the point where, at least from Brookfield's perspective, they're ready to start investing.
I just throw in there from a supply and demand perspective. We, especially in Canada, we had millions of square feet come on right before the pandemic and just into the pandemic, and we at one point, I think, vacancy rates were close to 20%. So we need a period of time here where there's some market absorption and vacancy rates can come back, and it comes into being more of a sort of an owner's market versus a tenant's market. And right now, like the sort of incentives you have to pay to get a tenant in are enormous, and office also happens to be very capital intensive, where you actually the owners have to put a lot of things in, restructure things, and especially when supply is not is sort of abundant, it's not a really good market for sort of the owners of office. So I think we'll leave it to Brookfield, but for now, there are probably better opportunities out there in the market than office.
I'll just pick up on that, because leave it to Brookfield in the sense that there will probably be a time, and this is not really, I think you mentioned before, this is not a do-it-yourself type a way to approach this part of the markets. You want some expertise, knowing what they're doing when the moment is, for something like office, for instance.
Yeah, I mean,
any of it.
If you think about any of these physical assets, particularly commercial, it takes hundreds of millions of dollars in some cases to create scale within that type of portfolio. It's one thing for a group of investors to band together and purchase a relatively small commercial asset, but you don't get the diversification along with that like you would get within this portfolio. And as a result of that, I think that there's a lot of qualities that are hopefully attractive to investors out there in that sense.
What about liquidity? So there is a minimum holding period. Just want to get to that. You said 3 to 5 years, but let's talk about that.
Yes. So in terms of the liquidity of the fund, as I mentioned, this is going to be a less liquid vehicle. So what that means is that for investors, we will typically allow a certain percentage of the fund's net asset value to be redeemed on a fairly frequent cadence. So in our case, on a quarterly basis. And we're targeting up to around 5% of the fund's net asset value in terms of available liquidity on that particular cadence.
Okay, so that's ultimately how it works. Don, tell us on sort of a day-to-day basis how you will run this. You run other funds, how we work, I guess, with the partners.
Sure. So my role in the fund is sort of twofold. One, sort of focused on liquidity and asset allocation. So we're basically starting the fund with the idea of 70% private, 30% public. I have the ability, depending on market conditions, to flex that a little bit one way or another if things get dislocated either on the private or public side. So one, I'll sort of act as the asset allocator, and two, I'm going to be running the public real estate portion of the fund, and that's just not me. That's sort of the whole real estate team here at Fidelity, and it's the same. Just as I run sort of the dividend fund here at Fidelity. It's same sort of philosophy. It's like good companies, reasonable prices, maintain and grow distributions over time. We want to be working with our real estate analyst here, finding the best opportunities, the best supply and demand fundamentals, where sort of earnings are increasing, distributions are increasing, and prices are very reasonable, and we can make money hopefully on multiples expanding at some point, going forward. So it's basically manage the liquidity of the fund, a little bit of asset allocation, and work with our strong fundamental team here at Fidelity and all the research capabilities we've got to bear across North America, and put the best real estate ideas in the fund.
Yeah, let's come back to the diversification element of it. Diversification has always been a very important term in your business, but in the last couple of weeks, I feel like it's really gained a new appreciation by really everyone, whether they're invested or not. Let's talk a little bit about being able to either not hide out from the market gyrations, but having a safer harbor, I think, is probably one of the attractive pieces to this. Just speak a bit about what an investor can where their sleep at night comes in on this fund.
Sure. I mean, I think there's a number of ways you can probably approach that question, to be honest with you, Pamela. Part of that answer may come from the fact that, like, real estate, whether it is privately held or whether it's through publicly listed real estate, tends to be a good diversification piece for investors over time, obviously to varying degrees. But the way that I probably first and foremost approach your question is private market vehicles are not subject to the day-to-day inflows, outflows, price discovery that's occurring within public markets. So the way that they're valued and the way that investors potentially utilize them within their portfolio might be a little bit different than that of some of the publicly traded assets that are available out there. But I think ultimately it can be a useful source of both diversification and return potential for investors over time.
Fantastic. Anything to add to that, Don? The importance of diversification right now. There is a change in markets. Some are calling it a regime change. Some are much less though than that. But there is a change afoot for sure.
Yeah, I mean, you certainly see it over, like, public markets move a lot faster than private markets, and the fact that values in private real estate don't move nearly as fast as they do based on sentiment and flows and, frankly, index selling or whatever the case may be on a particular day. Private markets are negotiated between the buyer and the seller, and the fact is, like cap rates and expectations of what real estate is worth in the private market sort of evolve over time. It's not on a day-to-day basis, and it's a negotiated process. And is not nearly as volatile, the values you see. And in some cases, you can find, like you think, okay, public markets are probably being overtly punitive, or in some cases, you can say, maybe private markets are being overly punitive, and there's a trade-off between the two. But the nice thing about having the private real estate is people are sort of looking at it when they're buying an asset. You're not buying it based on today's fluctuation in the stock market. You're buying it based on your view of your discounted cash flow, the growth in funds from operations or adjusted funds for operations, which is basically free cash flow, over the next 10, 20 years, and sort of what your expectations are there. It's not a what happened yesterday in the stock market. And that's kind of nice to have a portion of your portfolio that does have a little more stability to it and sort of a longer term perspective.
For sure.
And I agree. I just would add as well,
Please.
Don kind of touched on that point, but he's probably being modest in the sense that like there are times when in public markets, like real estate investment trusts can trade at significant discounts to that of net asset value, and we want to be there if that comes up, and that's the reason why the product's been designed the way it is.
So that it has access to those opportunities within the public markets as well. Why is Fidelity why are you offering this right now? You do a great amount of research study to decide what is offered, and where the demand also comes in there. Tell us a little bit about why this is being launched by Fidelity.
Sure. I mean, I'm of the mindset that as market environments evolve, as investor preferences evolve, like we want to have the right capabilities in place so that regardless of what type of an investor you are, something is there to potentially fit your need in that sense. So whether you're wanting to access a private asset capability through, as I mentioned at the beginning, one of our balanced funds or multi-asset class portfolios in a relatively at least relative to this product, in a way that's kind of like more of a smaller building block within a portfolio, or whether you want to access it in a way that is more concentrated, as we're talking about with the Fidelity Alternative Real Estate Trust, there's a number of different ways as to which you can gain that. So that's a long-winded way of saying why we're kind of launching this right now. It's not so much based on the particular environment that we're in right now for public or private real estate, although
you've been planning it for years.
I think I can make a case around either one of those. It's more about the strategic nature of the fact that we want this, I keep using the word capability, but it's probably the best word to use, over the next 10 to 20 years, because we think it offers benefits in its own right, but also when used in combination with other pieces in investor portfolios.
I think there's also a case to be made. Like, this is something where an advisor can take to their client and say, this is something you cannot do at home. And it's a wonderful product where like the work that gets done going into like sourcing an acquisition, having the relationships, financing that acquisition, going out and Rory mentioned this, having an operating platform that Brookfield does and has for decades to do the roofs, to put in like massive capex to release. Just having a huge network of people they've dealt with for decades to, okay, this is the right person to go into the building. This is the international relationships we have for all these companies to actually be able to put people in this 100,000 square foot space or 1 million square foot space or whatever the case may be. Those relationships are great. And this is something as an individual investor, you can't just go and do yourself. You actually need to go through it. And it's something that where an advisor can offer it to a client and say, hey, we've got something that offers diversity, offers income, capital appreciation over time. It can be a part of your portfolio, and you cannot replicate this at home. And I think that's really exciting.
Yeah, and just to add on to that, Don, I think that if you think about real estate investing, this probably applies to residential too, to be honest with you. But there's many different ways you can make money within real estate investing, but I think in a lot of cases, the biggest and best opportunities come with having a bit of a contrarian type of mindset. So being the type of asset manager or investor that goes to a space that's going through some sort of financial or operational difficulty at a particular time, taking a long-term perspective with respect to that asset, potentially deploying CapEx, as Don mentioned, so that you can realize that value 5 to 10 years down the road. And we think that with Brookfield, at least on the private side of this portfolio, we couldn't be happier with the group that we're working with.
That's amazing. So it's interesting to hear how you've been working together. Here's a sort of a specific question that goes to some of the things you've been talking about, but let's get a specific answer. So what kind of risk return profile is this similar to? REITs, equity markets? I mean, you'll speak a bit to each of these. What's analogous here?
Do you want to deal with the core plus sort of nature of the how it's been structured, Rory?
Sure. I mean, we can talk about that part, Don. So in terms of the private portion of the portfolios, this focuses on investing in core plus real estate. So
and these are in the major cities in Canada, roughly?
Primary markets in Canada. To describe a core plus asset, generally speaking, it's high quality in nature, but Brookfield's investing on a value basis. So what I mean by that is that the general traits or characteristics of a building would be something that has relatively high occupancy. It's usually in a good location. It's relatively low vacancy rates, as Don kind of alluded to earlier. But there's something about that asset, whether it's through the managerial or operating platform, or whether it's through the acquisition process, where we can potentially realize some additional value over time. So you're not just there to collect the monthly rent check.
Right.
What you're there to do is collect the monthly rent check, but also realize some capital appreciation through fixing up the lobby or leasing up another floor or something to that degree. But I think as it relates to try and position this from a risk return perspective for investors, and feel free to chime in, Don. From my perspective, if we're just looking solely at risk and return, this sits somewhere over a long period of time between equities and fixed income. In that it's the type of investment where you should expect a return premium on top of that of a fixed income asset. But at the same time, the volatility will likely be lower than that of equities, but depending on the bonds or fixed income vehicle you're investing in, maybe slightly above that. The true value proposition, though, is in the diversification piece, which we talked about earlier.
Fantastic. Anything to add to the risk reward?
Yeah, and let me talk a little bit about the sort of the public REITs and sort of maybe why that's sort of an interesting portion of the portfolio now. So we kind of went through a period in 2021, really good year for REITs. And why is that the case? Well, real estate is going to do really well. Interest rates were zero. And the economy was recovering a lot. So we had basically zero interest rates and a relatively improving or stronger economy. We've gone through a couple years now where we had a reset, and this has been a difficult thing. Real estate is interest rate sensitive, and everyone should know that. But we went through one of the largest resets in interest rates in sort of the history of the world. So zero rates went to 5. And you basically had a push out, sort of a compression of valuations for the last couple of years. Now interest rates, that sort of headwind now turns into a neutral, or in some cases a bit of a tailwind as interest rates, at least on the short end, come down, and even the long end they've come down a little bit. The other aspect of it was just supply and demand. When interest rates are zero, you can go out and finance a lot of stuff. So you saw that in the industrial markets, a little bit in multifamily, not as much in retail, but we saw a lot of supply come into the market. Interest rates go to 5, that supply stops.
Right.
So we've got a combination of interest rates coming a little bit lower, and supply, which in the case grew a lot over the last couple of years, is actually starting to dwindle a little bit now.
Yeah.
So
interesting time to enter it. I might just give the final moment of this timing to you, Rory, if you don't mind, because we'll have to wrap. We've gone through our time here.
Yeah, I'd just say that we're extremely excited about this new opportunity and this new product, and please learn more about this through your Fidelity sales representative. And we look forward to what the future has in store for this new Fidelity Alternative Real Estate Trust.
Fantastic. Thank you, Don Newman, Rory Poole. Very exciting, and I'm glad you could share it with everyone today.
Thanks, Pamela.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.